individual advice. It is instead just an update to educate and inform you all. So welcome one and all. I can see quite a few of you on board already, so that's good to see. You should all be able to see and hear me. Let me know, and indeed where you're all from. We've got Aberdeen, Gomersall, near where I went to school, Newcastle, Solihull, and we have Joseph from New York, Arif, hello, Burak, rather, Martin, Hertfordshire, David, Cardiff, welcome one and all, Norway, Mike, good, and Joseph, my friend, from New York, good, and Auckland, 9:30 a.m. Peter, thank you. So let me share my screen and get on with it, because we have got a lot. Get a comfortable seat, get something to drink, get a pen and paper as well while you're at it. You should all be able to see me, and I'm also broadcasting this live on TikTok as well. There we go. I'm just trying to get rid of something. If I can, there, that's better. So what are we going to talk about? Well, it's been volatile, but there are opportunities. It's not actually been as volatile as people seem to think. Remember, feelings are not facts, and people are feeling it's somewhat more volatile. But in actual fact, the market's been on quite a rip, and we're going to look at the data. We're very much data driven, so we're going to focus on data and facts and not on how people otherwise might be feeling in directions. Good. Okay, so remember, none of this is a solicitation to buy any individual stock or sell any individual stock. It is not financial advice, because I'm not speaking to you individually. I'm speaking to you collectively about education information. And by the way, my TEDx talk, which is going to be recorded at the end of this month, my third TEDx talk, is similarly going to be on some of the main things I'm discussing here as well. Jeff Malaga, full moon, you lucky person. Saturn and Jupiter. No, Venus and Saturn or Jupiter. It's one of those in the skies. Now, valuations. Where are we on valuations? This is really important that you understand this. So much can be learned from this image alone. What this is telling you is you're paying $27 for every dollar of profit Microsoft produces. Now, imagine you had a house which produced rent of $1 a year in profit, okay, for argument's sake, just $1 a year of profit. And somebody said you can buy it for $27. You might say, okay. But what if somebody said, no, you can buy mine for $13? Well, you'd say, well, the $13 one's a lot cheaper than the $27 one. So why would you not just buy all the cheap ones, like these green ones? When you consider that things like NVIDIA have gone up a lot more, i.e. the expensive ones have risen more, you realize that valuation, i.e. how much you're paying for profits, is not the only thing that moves stock prices. Momentum does, growth does, revenue growth, expected future growth does. All sorts of factors, including supply and demand, cash flow, do. Remember, all companies have three sets of accounts: P&L, cash flow, and balance sheet. All of those factors can move a stock price higher, and that's why we look at everything. Now, we will in this webinar look at the greens. We'll also look at the reds, because some of the money is coming from the reds, the overvalued ones, some from the greens. This is why when a wealth manager or a fund manager or an IFA says to you, oh, we're going to buy you some value stocks and some growth stocks, they're absolutely idiotic, because what it means is they think if they just restrict their purchases to value stocks and growth stocks, they're getting you a combination of value and growth. They're not. It's like saying, well, I'll only pick something from rubbish pile A and rubbish pile B, and if I mix the two, it get good. What you actually want is undervalued companies that are also growing. And if they're growing a lot, then you'll allow for more overvaluation. That's how Microsoft ends up in my portfolio, and NVIDIA does, and Apple does, and Amazon does as well. Because whilst they're overvalued, they're also growing. And the other factors such as cash flow. So if you only look at one dimension, no wonder you'd say, oh, the market's about to crash. Oh, this is going to collapse. And you'd stay forever single, never marrying to anything. Okay, so we'll look at that in more detail in a moment, but I want to educate you during the course of this. Now, you can take a picture of this if you wish. It's just the earnings which are coming out over the next 7 days. And what I should say is there's nothing which is going to move the markets. However, there's some important ones which people will probably keep an eye on. I mean, Cisco, for instance, after market close tonight, it's an important one, but it's not market moving. I'd possibly say how the energy sector is doing. Duke Energy out there as well is one. But anyway, if you own any of the stocks which are on here, you might want to take a picture and just be mindful there might be a bit of volatility around that period. Okay. Oh, by the way, wherever you are, especially if you're the TikToky types, do this. I'm going to be at TikTok's HQ soon to do a video recording with them. They've invited me. Anyway, value, growth, income. Here we go. Let's look at these things over here. This is why we want to look through 10,000 companies, because after all, I don't want something in my pension which I've not properly due diligence. The only way to due diligence is to look at everything that's available and then narrow it down, making sure which ones are undervalued, which ones are growing, which ones are producing dividend yields, which ones are croquet. And I'd probably say of all these things, this is the most important factor for me. Okay. These other things are okay. Sometimes they're nice to have, but the most important is value, growth, income. We know value is more important than growth from the academic literature and more important than income. When I started doing my Bloomberg TV show, I would literally have this spreadsheet on a laptop in front of me in the TV studio, and whichever stocks that came up, I would pull this up and discuss the companies that I was doing. And similarly, if I was writing in my Financial Times column, this would be the basis. I mean, without this, under my arm on my laptop, I was nowhere because I wouldn't have the data. If I didn't have the data, how can I make a comment? Otherwise, you're just ending up guessing things as well. I'm going to put a poll up for those who are watching the webinar, and I'm going to show you the results. So let's start off with the FTSE. I'm going to ask people, and those on TikTok can put this in the comment box. Will the FTSE be higher by the end of 2025 from today's levels? See what you guys say, see what you think. Okay, and by the way, on this, the reason this also saves a ton of time is, think about it, all this data comes from those companies and from the exchanges. So I've automated a lot of the process by then color coding, by putting in green those which are acceptable and then filtering. Can you imagine how many hours of work is saved? I first started investing in the 1980s with privatization stocks when I was 12 from money borrowed from my aunt. And at that time, I'd have to actually write to the companies to get their annual reports. They used to send them for free. They were obliged to send them for free. I think it was the law. And so I'd have all these annual reports and I'd read them and try and judge if a company was good or not. Imagine now, you've got all this data at your fingertips, makes life so much easier. By the way, I'll let you into another little tip. If you are low risk, you would want volatility under 10%. If you are medium risk, under 20%. And if you are risk loving, then you don't care about volatility. And another way to think of volatility is this. Essentially, if there was a down year in the market, 2 times the volatility is how much the stock would worst case fall. So be warned. That's why volatility is important. It also gives some idea of drawdowns during the course of a year. What's a drawdown? Well, if the price does this, the peak to the trough, that's a drawdown. That's how much you could lose. Now, we ideally want stocks which have a good high average return and very shallow falls or drawdowns and quick recoveries. That's what you want. This is what you want. Okay, what you see on screen, how do you determine that? Well, the Sortino is a bloody good measure. If any of you watch Billions, Axe, when pitching capital to a room full of investors, had mentioned how good their Sortino was in their hedge fund. I'll let you into a little secret. I set up my fund in 2004. I'll let you into a little cheating secret. You can just get the Sortino for individual stocks or exchange traded funds, and you just aggregate it, and that'll give you your Sortino. And then you can tell the clients, we generated this Sortino. No, you didn't. You bought a load of companies with those Sortino. Obviously, a hedge fund doesn't create companies. We own a little bit of those companies. That gives you the results we want. It's sort of backward reverse engineering. It's a little bit of cheating because we're looking at stock prices. But the stock prices are what matters. That's the output. It's all very well saying, I think management's good, and I think this, and I think that, and I think this. But it all has to be reflected in buying low, selling high, i.e. the stock price. And the stock price is, if it's consistently good, strong average and small falls and quick recoveries, then that's already telling you management is good, balance sheet is strong, profits are good, etc. The problem is, and why you need 10,000 companies is people don't look for that. What they end up looking for is any old volatile thing and saying, well, it's really volatile, so hopefully I'll catch it on the updraft and make some money. They turn investing into gambling, and we're not going to do that. Okay, now on the poll, 64% of you said the FTSE will be higher by the end of the year. Okay, I'll share the results. 64% said the FTSE will be higher. Let's look at the Dow. How many of you think with the Dow and what it will do? By the way, this is the past week of the market. It's been phenomenal for NVIDIA, up 12%, Broadcom up 5%, Palantir on a rip. We'll discuss Palantir later. Palantir over here, 8.4%. CrowdStrike, 6%, Oracle, some of the tech, but also the so-called consumer defensives, in particular Walmart and Costco. I'll come back to those later. As well, in the past, I've discussed Coca-Cola, Philip Morris on a rip, 13.5%. We'll discuss that later as well. And Meta, Alphabet, Amazon, Tesla, all coming up in the rest of the show, folks. Uber, I did a stock note on because on my Telegram channel for my private clients, because a hedge fund manager has got a big stake in it and has been talking it up. So I analyzed it, see if it's any good. And the financials are relatively cheap and they've been good. So we'll look at some of these, including healthcare, Eli Lilly. We'll have examination of in the course of this webinar as well. So a lot of stocks to go through. Over the past year, look at that. Now, if this happens again over the next 2 years, something like this, I'll be over the moon. A Costco, 46%, Walmart, 81%, Amazon, 37%. Ask your wealth manager, where the hell were your returns? And this is the problem with wealth managers. Why do they spray and pray into 100 stocks and put 1%? Why do they put 1%, say, in Amazon? Why do they put 1% in NVIDIA? So that when it goes up 90%, they barely make any return in your portfolio. Why are they spraying and praying if they're supposed to be so good? And the reason for that is they're not actually going for growth. What they're trying to do is minimize volatility. Well, a bank account will do that, which is why their performance is closer to a bank account than to the stock market. What stock market performance? Well, I'll have a look at you. Look at it. It's in front of you. This is largely the American market. I'll look at the UK shortly. The gap between the UK and the US over the longer term is going to increase unless there is a complete collapse in sterling, which I don't think there will be a complete collapse. It will continue being pressured to the downside, though, compared to the US markets. 66%, similar to the FTSE, think that the Dow will be higher by the end of the year. Okay, I'm going to do another poll. I'm going to just ask you about IFAs and why we all hate them so much. Okay, now let's have a look at some of these. Oh, I heard the worst possible excuse this week from a client who said their IFA had said to them when the client asked them, well, why are you getting rubbish performance, Mr. IFA? Whoops. And the IFA said, oh, you don't want those US stocks. And the client said, well, they've been going up for so many years. He goes, well, you know what they say, trees can't keep going up forever. Oh, my Lord. Stick to some of the UK steadier companies. Don't be too ambitious. Don't run too fast. I told Paresh this, and Paresh said to me, he goes, yeah, trees can't climb forever. But you know what happens as they grow? They get stronger and sturdier and less likely to be blown around by the wind and less likely to just bloody collapse because they're strong and sturdy and got wide bases. So, yeah. Anyway, honestly, the stuff these wealth managers come up with, because they know that the longer they can delay you taking out your money from them, the more fees they can keep charging you because it's a subscription model. Okay, ETFs, you'll get a separate webinar on this, but in terms of exchange traded funds, what's happening? Gold is the one which is doing the best at the moment. Gold's the one. And my wife bought some gold coins, physical coins. Somebody asked me which should she invest in. She actually got some gold coins. But you can see some others. I will do a discussion of these at some point, separate webinar, just pure on exchange traded funds. Where are we on the US markets? Well, the US markets, you're paying $31 for every dollar of profits in an American company. That's pretty much near its 1 year average. So it's not far from where it was over the 1 year average. Interestingly, the US market cap is 61 trillion, double the size of the economy, the American economy, and also roughly double the size of US national debt. roughly. So that's their stock market, pretty bloody strong. Profits have gone up 8% over the past year, and sales have gone up 5%, but prices of companies have gone up 20%. Variety of reasons, one being increased confidence in the US market, another being momentum. People just want to buy high and sell even higher. Still makes money. Now, these are the sectors and these are the valuations. You're paying the most for healthcare. On average, you're paying $31 for every dollar of profit. But if it's a healthcare company, you're paying almost $70 for a dollar of profit. And these are their forecasted growth, which is one of the reasons why you might be paying more. I don't care for what sectors a company is in. I want the company to be healthy. I base all of this on the individual companies themselves, a bottom-up approach, you might say. Okay, US market over the past 7 days, look at that. You got Philip Morris, Eli Lilly, Meta, Broadcom, and Nvidia. That's how they've done. And over the past year, well, wouldn't that be great if pension did that? Okay, you might even forgive Eli Lilly only being up 16% if the rest of your pension did that. It's not as if they're not household names. So again, wealth managers, IFAs have no excuse to spray and pray. The UK market, this is the UK market, you're paying £20 for every pound in profits that a British company makes, which is a little bit above its long-term average. It's gone up 14%, but profits have gone down 15% in the last year. So that's worrying. Profits down 15%. Okay. In the UK markets, you're paying $100 for consumer staple stocks. Sorry, £100 for every pound of profit they make, but they're forecast not to grow that much. Real estate, you're paying 73. It is forecast to grow 32% though. So I don't, as I say, look at this. So I'm not going to give you a strategic theory on what you should look at and why. A good mixture is, say, materials, forecast to grow 24, price earnings, so value, growth. I'm not going to do that because we're going to look at the individual companies themselves. We'll go from the bottom up. UK market over the past 7 days and over the past year, not bad. Some of these, Unilever, British American Tobacco, HSBC, AstraZeneca, BP, not so much. That might get a bit of a rise because Elliott, a massive American hedge fund, which is an activist hedge fund, it sort of starts kicking management in the teeth when it takes a stake, has taken a big stake in BP, and clearly they've worked out, which is why it's had a short-term rise, that they've worked out there's a gap there and they can fill. How are we doing for exchange-traded funds? This is how we're doing over the past month and year to date. Again, I'll do a separate one on exchange-traded funds, but what I want to show you at the moment is MSCI World, not bad, 44% over the past month. That's nuts. Weird. Okay. And what else have we got? Gold was here. So, China might be worth looking at this year, and gold. Okay, we'll look at China and gold in a separate webinar, but it is worth looking at to some extent. BRICS as well. Now, year to date, where are we? The Dow's up 4. The UK is up because the pound has fallen against the US dollar, and a lot of dollar-generated profits for British companies get translated into more pounds in the accounts. So it looks like the British companies are earning more in profits because they're earning it in US dollars. See, even they are earning it from the Americans. It usually doesn't last, and that's where we are, all positive. These are the major sectors. If you look at the major sectors, consumer discretionary materials. Now, the reason, and this is from start of January, and what's doing well? Well, communications, financials, energy. What does that mean? What's our action point? Well, our action point is nothing from this, because we're not going to gamble on which sector might do better and which might do worse. Okay. Similarly, if you look at themes, or styles rather, you can see at the moment momentum's doing well, and it is a momentum-driven market. What does that mean? Well, it's not because the stocks have got high dividend yields or growth, revenue or profit growth, or undervalued. You're paying a low share price for the profits they generate. It's momentum. It's none of those things. Now, remember, the way I pick stocks using that Excel spreadsheet that I showed you, and it's something we developed from during the hedge fund days, is this: undervalued, growth. So it's a subset of a subset. You remember your Venn diagrams from school? It has to be in the middle here. It has to tick the momentum box, the value box, the growth box, and a bunch of other boxes. And it's the tiny little company. That's why I need 10,000, because when I've got 10,000, only then can I filter it into 200, which are worth their salt, as it were. 200, which are worth anything worth looking at. So that's how and why it is done in the way that I mentioned. And I'm going to show you something in a second. If we look at this, okay, none of these are suitable for my clients. This is what I call the approved list. We then filter it to see what's green across there. None of these are suitable for my clients. And by the way, if you want to know the theory behind value, growth, income, or croaky, the education that I provide, that comes from the value, growth, income stuff has been shown by 3 economists in particular I relied on: Eugene Fama, Daniel Kahneman, Richard Thaler. They all went on to win the Nobel Prize in economics, and I've written about them in my books. And there's about 18 odd books out there written by me. And cash return on capital invested comes from Goldman Sachs Wealth Management. The other 3 on there all come from the hedge fund industry, which is the industry I'm a part of. Now, if you look at this, we haven't got all green across there, and therefore none of these are suitable. Can you see the problem? None of these are suitable. Okay, and some of the high volatility ones I'd rather not have at all anyway. We'll come back to this a little bit later on, because there'll be other things to show you as well. Now I'm going to show you also several other important things. If you've got a pension, you can. This is from Goldman Sachs Wealth Management. It's a little bit conservative, but you would look on here, years to retirement, and then we decide how much you should have in cash, how much in stocks, and how much in funds, lower volatility funds, and the funds are down here. Okay, generally 20 to 40 stocks, money divided equally. If you want to keep it really simple, you'd probably do something like this: an S&P index and the quality 5, and then some cash. Right now, we're going to go back to individual stocks. And in exchange traded funds as well, we'll have a look at. Exchange traded funds, I've got data on 7,000 of those. They tend to have less volatility, but it doesn't mean they're poorer performers by any means. I'll give you an example of exchange traded funds, and these again don't meet our criteria, but you can see here, you've got ultra consumer services, 52% up, volatility 20%, not bad. But the point is, the reason we look at so many is because we need to filter down to the very best of the best. Okay, because it's my son's junior ISA, my wife's SIP, and for those reasons, I need it to be the absolute best. By the way, I'll close the poll on your frustration with your fund manager or pension performance. Underperformance is what 65% of you said is the most annoying. And secondly, not trustworthy. Number 3, lack of information education. 4% lack of transparency. Absolutely agree with you on all of those. Underperformance always comes up number 1. And it's a shame, because over the past year, the Nasdaq's up 20%, the S&P's up 20 as well. However, what I teach people is, and the reason I like to give the transparency of giving them all of this data for my clients, is because I want to educate them and empower them so they understand why anything has been selected. So they don't have to take my word for anything. They can just see themselves what the data is, how to use it, and why things were selected. And then what's the credentials behind picking that? Was it Goldman Sachs? Was it a Nobel Prize winning economist? It's got to be a really high standard, because it's got to be good enough for my son, basically, in his ISA. Now look at this over the past year. 20% on the NASDAQ, okay, but look at this. For the best part of a year, what is that? 7 months, 0%, but you still had 20%. This is why Warren Buffett says the stock market is a place for taking money from the impatient to the patient. Most of the times, I don't have to do anything. The market does one of 4 things. Only in one of those 4 occasions does it actually go up. Okay, only 1 out of 4 times is it going up. The other 3 times, it's either going 0 or falling or rising, then dropping back and losing all the money it made. So 3 times out of 4, you're not happy. 1 times out of 4, you are. To put that into, again, I'm very data driven. So to put that into context, in 2021, Microsoft went up 50%, yet 9 out of 12 months, it was 0 or negative returns. Got it? Right. So you can see that's how 50% is generated. The good news is about all of that, most of the time you don't have to do anything. Just let it do its thing. The bad news is if you don't know that, you're going to panic and keep selling and buying and over trading and be messing up your pension and your portfolio. Top 10 FTSE 350 stocks, price over the past month, it's these. St. James's Place is not because they're performing well, it's because they're advertising more. And the result, and their stock got battered last year. The result of that, when they get more customers, is 12 months later, I get more customers. And the reason is, after it takes them 12 months, those new customers to realize how bad they are, St. James's Place are, and then they come to me. Simple as that. The reason these wealth managers, and I'm picking on them as they're one of the big ones, are so bad is because they're very good at advertising. So they have billions under management, which means they've got to divide it into small funds. Otherwise, they'd have one big fund and they couldn't sell you more products. And also, they'd end up taking over companies because they'd have so much money. So they divide it by geography, style, like growth, value, and theme, like artificial intelligence. All sounds very good. The problem is that's like saying, I want to pick a winning team, but only from people in Watford, or people who are above 5'10". You've restricted the numbers so much that you just can't do it like that. Okay, it is not a sensible way of doing things. Okay, so the reason I mention all of this is because people don't understand why fund managers underperform if they're experts. It's because institutionally they're handcuffed. You're not handcuffed. You don't have the problem of billions under management. The other problem is they've got 20,000 clients in each fund. So they don't know who you are. You've never spoken to a fund manager. You might be joining after a good run or a bad run. And the research data, which I've published in my Financial Times column, shows that people tend to pick last year's winning fund to put money into, because they're the ones that they're going to get advertised to. And there is no consistency of performance in fund manager results. We know this from the research. Eugene Fama got a Nobel Prize in economics for showing this. Therefore, you've put it into last year's winner thinking they've got some consistency or persistence of performance. In actual fact, they don't. So looking at last year's performance, which we don't do, for instance, is not a good way of picking a fund. You're far better off looking at a long-term Sortino, alpha, the ability to outperform over the long term, the market's volatility, for instance, and so on. Anyway, S&P 500, where are we? Well, as I've said, month in, month out for a long time now, we're overbought. But like so many of these overbought, and I'll explain what this is in the bottom half of the graph in a second. It can continue, and a lot of it has. That suggests there's more momentum than value driving it or growth driving it when this is overbought. What does overbought mean? It means that that dotted line is in the top quarter or third. What is that dotted line? Well, I'll tell you. It is a measure of, imagine this is the average price. You see how that line I've drawn? That's the average price, and it's increasing. Let's make it simpler. Imagine for a minute you had a stock, a hypothetical stock or security where this is the average price. Okay, now imagine the actual price moves around that average like this. So what this is measuring is it's saying if it gets too far from the average, it reverts back to the mean, reverts back to the average, undershoots because stock prices overshoot and undershoot, and then likely to go up. So this is trying to measure when it's got too far off its long-term average, thanks to momentum, and is going to pull back. So it's measuring the distance between the short-term and the long-term average prices. The principle being, if the short-term price gets too far from the long-term average, there'll be a mean reversion. Now, it is not guaranteed to work. If it was, I would basically, quite frankly, be the richest man on the planet. If anything in the stock market was guaranteed to work. But it's all about a sliding scale of probabilities. it is pretty good. Good enough that with diligence, we can make money from it. So at the moment, it is overbought. It could drop, but it's not what I call a daddy bear, which would be that scenario there. Okay, 2022, when we had to hold cash. Now, because we don't have a conflict of interest with you, where I don't have a brokerage, or I'm not an IFA, I'm not charging you a subscription or fees each month to manage your money. Therefore, I can just tell you, hold cash. In 2022, it was hold cash. It isn't that scenario at the moment, and it might well continue upwards. So bottom line, therefore, becomes, tonight, what should I do, Alpesh? Well, I'm happy to continue holding what I own in the S&P. Okay, I've got triple leverage in S&P ETFs, I've got double leverage, and I've got single tracker in the S&P. Now, what if I didn't own those? Well, if I was risk-loving, I would happily get in, because a risk-loving person buys even when something's overbought. They buy on momentum. If I was risk-averse, I wouldn't, because a risk-averse person never buys anything overbought like that in the top part of the top part there. And if I'm risk-neutral, I would dollar cost average in or add to winners, okay, as risk mitigation. Now, what about the daily S&P? Where are we? Well, it looks like we've got overhead resistance there, something of a triangle there, and we should get some breakout to the upside. At the moment, it looks like we're going sideways for a little bit before we break out to the upside, right? NASDAQ, exactly the same as the S&P. It is somewhat overbought. There is a danger it will eventually fall, but that's not at the moment. And only a fool anticipates a fall. So I'll give you an example. 2022, a fool will start saying in 2020, oh, it's going to be a market fall. There's going to be a market fall, then here, then here. In fact, they would start saying, yeah, market's going to fall, market's going to fall. And they're going to stay on the sidelines whilst everybody else is making money. The trick is to know this part. When you get that crossover, that's a daddy bear, you get the hell out. We're not at that situation yet. The FTSE 100, all-time high. There you go. It's at an all-time high. Let me just close this poll. I know you'll have asked me some questions. Apologies, I've not gone into them as well. Okay. As well. Okay. Thank you, Phil. Very, very kind of you, my friend, to mention that. Now, with the FTSE 100, we're at an all-time high. That's because the pound has got cheaper. That's the principal reason. There's another reason. Statistically, and like I said, I'm all about the data and the research, data and research, data and research. I don't base things on my feelings. Statistically, when a country is about to enter a recession, the stock market tends to hit a bottom and starts rising because it looks 2 quarters ahead. And recessions on average tend to last 2 quarters. Okay, so we may well already be in a recession, but even if that to one side, the pound falling, perversely, these are the FTSE doing well. Okay, I know, it's absolutely crazy. Sadly, your pensions won't necessarily be doing so well, and I'll tell you why. They will have a large chunk of bonds in them, and the price of bonds has actually been falling as well. A classic example of that was during Liz Truss, when the FTSE hit, at that time, an all-time high, because the pound collapsed, and bonds dropped because there was a fear that the British government might even default on its national debt payments. And so when they were mark to market, your pensions dropped. There's an article I'll show you later about that. S&P 500, 2 times leveraged, as you know, I've got, and I don't need to take any action at the moment. I don't need to sell that at the moment at all. Okay. Dan, yeah, I think China this year might be worth looking at on the ETF side, and of course on what was I going to say? Also on the ADRs, like JD.com and those as well. Okay, as well. Okay. Now let's go on a little bit further here. Oh, Alpesh, those performance figures appear to have the column heading swapped. Oh, I better have a look. Performance figures had the column heading swapped. Where was that? I better check. Somewhere. I'll have a look. Not sure which ones. Is it something here? But anyway, let me know which ones you're talking about in case there is something swapped. So no action for me to take. Only a risk-loving person ever does leverage. All right. S&P, which are the big movers over the past month? They're these. So let's have a look at some of these. Let's have a look at CrowdStrike. T-Mobile we've had as a pick earlier, but before. Let's have a look at GE Aerospace and some of these and see. Yum Brands, I don't think I've ever spoken about. The others I'm pretty sure I've mentioned at some point in passing. Other than Philip Morris, I might not have. CrowdStrike probably just to say awful things because they're the ones who blacked out the airplane, the planes and the hospitals and all the rest of it as well. So I'll answer the rest of the questions later. It was the UK market review. Oh, what was it on a slide here? UK market review. Anyway, if you could give me more detail on that. It wasn't on my Excel spreadsheet, was it, Ian? As long as it wasn't the Excel spreadsheet, then I'm fine. Now, let's have a look at some of these and see, let's do an analysis. What's happening with the market? So I've just taken what's happened over the past month. I have a data team and a graphics team, and the data team send me a load of stuff, and the graphics team put all this together. So I'm looking at this at the same time as you. So this is Philip Morris. Now, on a value growth income rating, which is probably my most important of the ratings, it's a 9. There's a problem. It's significantly overbought. Now, if you wanted to do if you put a gun to my head and said, no, you've got to develop a strategy for me, then projecting that forward, even conservative, would put you at 23% up there, probably a little bit higher. And you'd probably put a stop there. Now, as long as you can get a 2 on the reward to 1 on the downside, then that's okay. But here, in this case, as you can see, looks a bit iffy if there's enough upside left and it's overbought. So a risk-averse person would never get into something overbought. A risk-loving person, of course, they have no issues, but you'd really want to make sure you've got 2 on the reward to 1 on the risk. And should it hit your stop down there, you shouldn't lose more than 1% of your portfolio on that, okay? CrowdStrike, again, not a 7, 8, or 9, so not one of my special situations. If that trend continues, then you're looking at a whopping 132% to the upside. But this is volatile. Look at that. 50% drops are common. So that's where you'd put that. Now, it shouldn't go here if it's going to go up here. So you do have a multiple 2 to 1. So it's more a momentum trader's trade. It's certainly not an investment in the conventional sense that I look at value growth income because it doesn't tick my boxes. But as a trader's investment, well, you've got 2 to reward to 1 downside. See the projections. The real question then is, do you think it can deliver on all of that? Okay, because we're not looking at fundamentals there. You're really literally looking at momentum, and that's it, and the chart. Okay, T-Mobile, it is a value growth income, but it is overbought like so many of the others. So you'd really expect this to continue, and you'd probably put a stop loss there. But I don't think the reward to risk is 2 to 1, if I've done my maths right. It's close, actually, there on that. But it is overbought, so it wouldn't fit into one of our conventional special situations. Okay. Now, GE Aerospace. Right? Similarly, look at that. Very consistent in their returns. You've got this. You'd probably put a stop down there. You've got a 60% to the upside. But like I said, it doesn't fall into what we'd put into a pension because it doesn't hit our 7, 8, 9. So we're very strict what we put in. The reason I'm showing it is it's one of the big movers of the past month. So it's not part of the Great Investments Program. 8 overbought, but look at that, soar ahead. And if you wanted to do it, you'd put your stop there and that'd be the upside. Okay. 7, but overbought, like so many of them, right? Like so many of them. And you'd put your stop there and there's your reward to that side. You're looking at 106% if it continues at that trend. Okay. Starbucks, well, it has broken out of one of those triangles there, and you'd probably put your stop just below there. Very simple. And you're looking for this to continue upwards, right? Netflix, it's a 7, but it's overbought like so many of the others. Now, Netflix I've been covering since God knows how long. Let me see, since here. I don't own it. I don't own any of the ones I've just mentioned just now on, which was on the monthly, just so you know. Okay, and again, you'd probably put a stop there and you'd look for that, right? 2 to 1 reward risk. I've covered it in many of my books. Thank you, Ian. Oh, thank you for that. I will go over that later on. That's really helpful. Review. Yum Brands, look into that company. It's really fascinating. I think they own KFC, amongst other things. Again, broke out of this triangle. I can't remember which of my books it was, but I think in quite a few of them, I've gone into technical analysis. I first got into looking at charts when I finished university and I had a summer free, and I stayed in the libraries and just read and stumbled across it then. So I was in my mid-20s and it just blew my mind. And combining that with fundamental analysis, I enjoy, because I'm quite a visual person. This worries me that it's falling, but it has broken out. That isn't enough to the upside, so I really wouldn't like it. Supermicro, Bitcoin bet, weekly going up. That hasn't turned around yet, so it's very high risk. I guess you'd put a stop here, but that's a big bloody drop. Okay, and that's your upside if ideally it works. It is a 7. It isn't oversport, but this is volatile. And generally, I say to people, if there's volatile stocks, why go down a bumpy road unless you really want to? Supermicro was our top selection from last January. We didn't know it was going to be. I did a broadcast on January the 11th for the subsequent 12 months. I mean, I do broadcasts each week, but the January one at the start of January had 29 stocks. 5 hit their stop losses. 5. Okay. I'll show you the performance in a second. And that's unusual. You wouldn't normally in such a good year get 5 wipeouts out of 29. So, unusual. Now, 7. But anyway, that's the direction. A bit volatile. But if you're okay with it, then it's fine. Costco was one of the big movers of the past month. Nice smooth upward trend. There you go. Okay, it continued upwards, even though it broke above a previous high there, which normally they tend to fall back, but this didn't. And there's a lot of that. That suggests there's more on momentum than there is on fundamentals, which is still okay, as long as you keep a close eye on it. And you probably want to put a stop there and go for that 44. Apple, I'll discuss with clients, because these are my core holdings. So the clients, if you look in your private Telegram channel, you'll see it there. Bank of America, as I said, each week I cover this. I don't own it. It's to give you a stock market update. And ever since I've been covering it, of course, to showcase how this average price movement works, it's been doing rather well, as you can see. Joanne, what ticker symbol for S&P? Doesn't matter. Whatever your broker offers, they're all the same, just different providers. So it really doesn't matter which ticker symbol you use for S&P 500. Netflix, and in fact, I don't even know. It's not the kind of thing I remember off the top of my head. I do remember, I don't know. Microsoft is MSFT, of course, but I don't remember the ticker symbols for the S&P. Netflix 7 is, look at that. Now, Netflix I don't own, but I've been covering ever since it had this collapse here and then had a dive up, just to showcase this. Just out of interest. Now, in hindsight, do I wish I bought it? Well, I guess it could be an idiot to say, oh, well, it tripled. I wish I didn't, but I can't buy everything. So it really showcases 2 things. I can't buy everything. And secondly, I don't know how much they're going to go up. Got it? Right? We just look at, are the conditions right? If there's a tailwind, we should do well. Okay. I'll answer the other questions as I go through as well. Walmart's at a 7. Again, look at how smooth that is. Now, wouldn't you prefer something which is smooth like that than something which is like this? It shocks me that private investors find stocks which go up like this and dive into them, or don't even look at the price, the chart rather. Okay, wouldn't you prefer something which is smooth like this? Now, that should be there with the stop loss just underneath. Berkshire, again, not one I own. Now, Walmart, by the way, I don't own, or Costco or Netflix or Bank of America, but I'll keep an eye on Walmart and Costco for the future, because when they're a bit more oversold like here, and history repeats itself in the market and goes back down to this, not this price point, but it'll go back to this kind of level, then we again will look for a 50% gain to capture. Okay, Eli Lilly, not one I own at the moment, but one which I will keep an eye on for the future, because I'll be looking for those returns. At the moment, it seems to be going through, well, maybe a consolidation. Maybe you put a stop loss there and you go for your return there. Don't forget to follow me on all of this. I'm at one of the top voices, like Bill Gates, except he's got 35 million followers, and I think I'm closer to 25,000. So it's probably the proportionate difference ratio in our wealth as well. He's on 35 million. I'm on 25,000. Actually, I should work that out. Top voice as well. So do look at the articles and columns on there. So how did we do last year? Like every year, it was weird. Now, let me explain what I mean by weird. It was weird in that this is last January's broadcast, okay? So it's 12 months. We do a calendar. Yeah, I mean, I could do February to February, March to March, June to June. And the differences would be quite significant because if you did July to July, well, we're not in July of this year yet, but I'm sure it might be significantly different. Even 3 months can make a big difference over a 12-month period. I didn't know that was going to be the knockout winner, because if I did, so here's weird thing number one, I don't ever know what's going to be the knockout winner. If I did, I would have said just buy that and nothing else. Okay, so point number one. Point number two, a lot of these are household names. Nvidia, yeah, it's not rocket science. I'm not trying to be the cleverest person. I didn't know Goldman Sachs would go up that much. I thought it'd do well, but I didn't think it'd go up that much. If you remove, say, some of our leverage plays, two of our leverage plays, out of the 29, this is not all 29, obviously, as you can count, that doesn't change much. It drops to about 39, 38%. So the fact that you've got 29 and your money equally divided amongst them means any individual one isn't detracting or adding too much. So there has to be a consistency of performance anyway. The other thing which was weird was I did not expect that return in 2024 because 2023 had been so strong. I was expecting something more reasonable. Of course, we do when we're looking at these. We do try and target that. We project forward, like here, even with the biggest companies, to have big returns, but we're not guaranteed it as well. Joanne, that one I'm only covering for my private clients, I'm afraid, because they get annoyed if I talk about the core holdings. Like I said, and this is what Warren Buffett said, we don't have to be smarter than the rest. We have to be more disciplined than the rest. And the discipline comes from the Excel and the format. I continue. This should be no news to anyone. I continue holding Microsoft, Apple, Amazon, Alphabet. One of my clients said to me, well, why are you still holding Microsoft? It's gone 0% over the past year. It's pretty much 0% over the past year. And I said, well, it's one of my core quality 5. And I explained to him why, because looking at it, and he said, oh, okay. So it's not all about everything has to be delivering all the time. We do it, and I think the best way to invest is have a checklist. Okay. Thank you very much for all the people who've given wonderful of these. I'm going to answer some questions. There's still a lot more to do, and there's some more things. Juan from Australia, fantastic. Would you be able to do an analysis of Alphabet? Sana, it's one of my core holdings that I give only my clients, that and Meta. So I've said I already own it. I've still got a fair bit to do. What do I think about ONS? Let me put that up for a second. Okay, there's still a few questions to answer, I know. Hopefully I've sort of explained the core principles of what we're trying to do. Very data driven. Okay, on semiconductor, somebody's asked me, oh my God, that's falling off a bit, isn't it? On semiconductor, I guess if you own it, you're really hoping that this is the base. You're really hoping it's the base. Now, arguably, this is a shoulder, a head, and a shoulder, which usually means that peak to neckline replicates itself in terms of depth. So worst case, this could fall another 50%. Your best case is it's found a support, maybe a little bit lower, maybe down to about here, it's got a support. Okay. And then it starts sort of like it did there, starts recovering. But I've not looked at the fundamentals on it. All right. I'm not going to be able to go through tons and tons of stocks. I did want to show you this from Goldman Sachs, which I came across recently, and I've written about it in my book. In actual fact, for those who are on the webinar, I'll just give you a copy of the book. You can read the book here. I've written about this fundamental process. This is why I'm looking at the data, because what they're looking for in Goldman Sachs Wealth Management as well, and they advise some of the richest people in the world, is essentially these components. And the way we find this, I'm less concerned about this, by the way. I think they've just put that in to seem woke. The way we find this is through the numbers, through the data, quantifiable. And they do the same. They're just looking at the same data. They're looking at what can be quantified in terms of balance sheet, cash flow statement, and P&L, and that's absolutely critical. By the way, these are the top yielding stocks, and I sometimes get asked by people which ones are giving the greatest yield, and I looked at these for my clients, and none of them appealed for yield, and I'll tell you why. In the case of some of them, the stock price is dropping like this, and some of them have dropped 50%. 50% in a year. So what's the point of having 7.8%? The time you want high yield is if the stock's going to go like this, let's say, or preferably even rise, and you're going to hold it for a long period and you're going to keep getting your yield, in which case you don't care that the stock's not moving. But when they're falling sharply, what's the great point of getting a big yield, especially when you consider the people who want yields, and I get 4.5% from a bank account, the people who want yields are the ones who are closer to accessing their pension. So more likely to pull their money out, more likely to suffer from a drop in growth. This is why journalists get it wrong so often. Be careful what you read in the press. I want to show you this from today that I came across. Well, I came across this today, I should say. It's actually from the 11th of February, so it's from yesterday's paper. This is awful. The headline says, Britain sleepwalking to pensions crisis as Labour delay reviews warns Standard Life boss. Now, the Standard Life boss is essentially saying that people need to save more because the pension returns are poor. They won't have enough for their retirement. Now let's look at what he's actually saying. He's saying, I, Standard Life, who manage your pensions, are delivering a piss poor return, and I want you to give me even more money so I can earn more money from you. Well, how about somebody said to him, and nobody's had the intelligence or gumption in government or elsewhere or in journalism to turn around and say to Standard Life, why are you producing such shitty returns then, mate? That's the problem with what's happening with financial journalism at the moment. Absolutely ill-informed as to what's going on. Don't take my word for it. Eugene Fama, Nobel Prize in Economics, for showing that these fund manager companies produce poor returns. Why? Because like I told you, they pick from a very narrow pool of, this is a UK fund, this is US, this is growth, this is value. So they're picking from a narrow group, which means statistically they're less likely to be able to filter down to the best of the best. Like saying, well, you can pick the England football team, but everybody's got to come from Bradford and only from Bradford. It's not exactly going to be getting to another Euro final or a World Cup semi-final, are we? I know we've done improbably well. Now, so be careful about yields. This is amazing. This is amazing. And I've got to show you this. Let me explain what this is. This is a statistical, my son's got a bloody lisp as well, a statistical projection of the S&P 500. Okay, so it's not guaranteed to happen. It looks at the historic movements and then does what's called a random walk. It's a statistical way of projections. Okay, it's a bit like, do you remember Brownian motion? You put pollen in a petri dish full of water and it moves in a random direction. But you and I know it can't move a mile in a millisecond. So it's random, except it's random within the constraints of its of how it's moved historically. Okay, so this is what again, it's not guaranteed, but you've got a 95% range over the past year. Over the next year would be somewhere between up 60% to -2. You can see why I've got triple leverage on the S&P, not just because of statistics. Now that's the bit people forget. Statistics is what a lot of hedge funds use. Momentum is what a lot of hedge funds use. Whereas journalists and magazine writers and tip sheeters, and I hate tip sheets because they've got a subscription, so they've got a natural conflict of interest with you. They're selling you a subscription, so they've got to dish something out every week. If I think something's rubbish or the market's falling, I'll just say hold cash. I've got nothing this week because I'm not charging you a subscription. And that's got to be critically important. So tip sheets, rubbish. So what happens is with something like this is I'll just tell you what I own. And I've got 3 times leverage. I don't think that's a secret. I don't think my clients will be upset that I've said that. Okay. And that's the random walk. Now, there is a possibility it could be down for much of this year before rising. As I said, this is not guaranteed, but it is based on what's called a log normal random walk. Now, the problem is this, and this is where people go bankrupt, hedge funds fail, is this. I'm going to tell you one of the reasons why hedge funds fail, if any of you is interested, or indeed why you, if ever you do spread betting or CFD trading or leveraged investments, you too will blow up and go bankrupt. Now I'll tell you why. Okay, see that where I said log normal random walk? Okay, there's a book called The Smartest Guys in the Room. It's about long-term capital management, the massive hedge fund which nearly brought down everything else. It is because that's not how things move. They don't move on a normal, what's called a bell curve. Do you remember from your maths, bell curve? A lot of things in life, like people's IQs and heights, they're on a bell curve. I don't know if you know this. Okay, height, speed at which humans run, IQ, it's on a bell curve. That's the average, the mean. In the case of IQ, that's 100. In a country like the UK, go on Twitter, it's like 5. But anyway, okay, approximately half the people above, half the people below. That's a bell curve. With stock market price distributions, there's something called fat tails. In other words, these extreme moves to the upside and downside happen more frequently than the data suggests. And so what hedge funds do is they say, listen, let's put $1 billion into the S&P, okay? So they put $1 billion into the S&P, and then they borrow 10 billion from the bank off the back of it. The bank says, yeah, Alpesh is a good bloke, let's lend him 10 billion. So Alpesh puts 10 billion in, $1 billion of his own money, 9 billion of the bank's. And the S&P doesn't drop 2%, which is what he's allowed for. And the bank said, well, if it drops 2%, we'll be all right, because it's not, he's still got his billion, he can just pay us out of that, right? 200 million he'll give us. Fine, not an issue. It drops 20%. It's got a fat tail. Alpesh hasn't got the money to pay the bank back, borrowed too much. Every financial crisis, that's what it is. Every company that goes bust, every property developer who overextended, that was it. Okay, interest rates go up more than we ever thought. It's the same, by the way, with climate change, a lot of other natural phenomena. They're not on the bell curve. Some things are on the bell curve, like height. Many things aren't. The tails are fatter than statistics generates. Okay. Oh, by the way, check out my YouTube channel. You'll like it. You'll see my interviews, including my TV interviews. There's a whole load where I've gone into a lot of this stuff and why pensions are performing poorly. My TV appearances on the BBC, CNN, CNBC, the stuff I've done with Investors Chronicle, which is owned by the Financial Times. There's a heck of a lot of TV stuff if you're interested on that as well, where I'm talking investments as well. In defense of offshore investing, offshore funds. And I've also got my interviews with the London Stock Exchange on that. Anyway, oh my God, look at that. That is, nobody needs that much Alpesh on television, do they? Now, let's talk more about the markets. Palantir, for instance, 3 years ago, I don't buy everything. I didn't buy it 3 years ago. It was one of the things I put on my private Telegram channel. And of course, it's gone up tenfold in 3 years. Nuts. If I knew that, it would be the only thing I would have mentioned. And so just to reinforce that point, I don't know. I don't have a crystal ball. I don't have a time machine. I don't know how much something's going to go up. What we know is if there's a tailwind, we should do rather well. Okay. What I want to teach you and what I'm going to talk about in my TEDx talk is the same thing that Eugene Fama got the Nobel Prize for. The biggest funds, if you're with St. James's Place, Fidelity, 91, Bailey Gifford, Lion Trust, watch out because their performance is pretty shit. And the reason is institutionally, like I said, they can only pick from a very narrow group of equities. And in a down market like 2022, they can't go into cash because they're, as a fund, they're not allowed to hold cash. They're not a bank, they're a fund. They've got to hold funds. The regulator requires it. So institutionally, they can't do things you can do, and that's going to screw you up. Okay. Somebody said, of course, yield goes up when share prices go down. No. If you buy it at the lower price, yes, but you didn't buy it at the lower price. You bought it when it was at 7.4. That's the price you bought it. All of a sudden, you're not about to get more dividends because the number of stocks you got stays constant, even if the share price stays down. What you meant is the yield goes up if you bought at a lower price and the dividend stayed the same. Okay, So you've already bought it at the higher price, and then the price falls. Your yield hasn't gone up. You've got the same number of shares, therefore the same dividend per share. The dividend per share doesn't increase just because the stock price has fallen. 10 of the biggest underperformers by size of fund. 3-year underperformance versus benchmark. Again, watch out for anything by St. James's Place or Fidelity or 91, Bailey Gifford, Lion Trust. That's underperformance versus a benchmark over 3 years. The benchmark being usually an ETF or tracker you could just buy yourself. Okay, you could just do it yourself. Now, this, I believe, is going to increase this poverty gap, which we've seen over a number of years between the US and the UK markets. Okay, unless, as I said, the pound collapses. If the pound collapses, you'll be fine. The FTSE will do well, but it's a sort of like we're going to devalue the currency in order to boost domestic growth in the short term. It's not a clever way of doing it. Why do I think this is going to go up? Well, let me put it this way. I'll give you a couple of pointers. The US administration, the current one, has already said very clearly through the Vice President Pence, when he came to Europe, we're the big dog. Don't regulate us. Don't fine our companies. Otherwise, we're coming for you. It's quite clear they've got a very nationalist, aggressive economic policy, and whether you agree with the politics or not. Okay, the European view is, how do we regulate, tax, all of this? Growth is secondary in Europe. What matters more to Europe is regulation. It should not come as a secret to anybody. Growth is secondary. In America, growth matters more just because of their political culture, their economic culture, their roots, and everything else, right? So that's one thing, technology. The second thing is just look at what their current president has said. Our prime minister said, or our chancellor said, corporation tax 25% for the next 5 years. Okay, it used to be 19. There's no statement about being the lowest corporation tax or anything else. Now, tax can be a big fuel for growth. So we're more concerned about removing assets to give them to working people. They've said that. In the US, they've said we're going to make corporation tax lower because they're going for growth. They want lower interest rates. Now, you might say, well, that's going to fuel inflation, blah, blah, blah. This gap's going to get bigger. If anybody thinks that the UK in the short term is going to be overtaking the US, absolutely wrong. That doesn't mean I don't like the UK. I like the UK. I want British pensioners to be riding the coattails of those clever, hardworking Americans and bringing their money here like I do from those profits and spending it in the UK as I do. Okay? 65% over 2 years. Brilliant. It's been a good couple of years anyway with the markets. Okay? On that, let me just make sure I've got all the chats. This is the bit that I wanted to tell you about. Your pension lost a fifth of its value this year. We reveal a lottery of returns on work retirement plans. If you're on work retirement plans, workplace pensions, just call them, ask them, what's my default plan? Why is it so poor? Now, usually what they'll do is they'll say, well, you can switch to any other plan within here. Okay, so they really do handcuff you because they earn a lot of money out of you working like a dog. You are working to earn them fees for them sitting on their asses. I mean, don't get me wrong. I'm in the finance field. I sit behind a desk. That's what we do. People out there work their asses off. I know. Okay. The point is you might be able to switch into one of the other handcuffed funds that you've got, which might be more suitable to the growth goals you have. So at least speak to HR and say, look, what the hell crappy fund have you put me in? And it's usually a default one. It's usually Standard Life or True Potential or somebody like that. Okay, which is why the Financial Times had this story: give workers power to ditch pension schemes. UK regulator call for reforms to workplace retirement pensions. Okay, it's not me, it's the Financial Times. She's the chair of the pensions regulator, and she knows how bad workplace pensions are. They are an absolute scam. But it doesn't mean you shouldn't have a pension. You should definitely have a pension. What I'm saying is you should make sure you're not just in the default one. Make sure you know what you're in. It's your money. Listen, it's your money. At least find out what they've invested you in. Pensions, why do those retiring face massive losses despite FTSE highs? Okay. Aviva. Aviva's a household name. Surely these experts should know what they do. Dropped 20% in value. Okay. So just be careful that you're aware of what the hell's going on, because sometimes Well, the most heartbreaking thing is people write to me and go, I've been working for 20 years and I thought I'd been saving and saving, and you have been saving. And then they look at the piss poor performance of the manager and they never looked at it and they trusted them with it. And it's like, what the hell? You know, where is the growth? So at least please keep an eye on it, see what you're in, and learn about it. And being on this webinar is good for you anyway. It's education. Have British fund managers become a pointless expense for investors? That's the Telegraph. So you've got the Guardian on the left, you've got the Telegraph on the hard right, both knowing that this rubbish is going on. Worst fund managers take $500 million in fees from investors. Okay, it's just how it is. It's really bad. They're taking money off you. That doesn't mean you shouldn't have a pension. What it means is you should be knowledgeable, informed about it. It makes my job easier educating people because, you know, a little bit of knowledge goes a long way, I've been writing in my first column in the Financial Times was in 1999. So everything that I've told you today is just stuff that I've already published and discussed. I've just updated the data. My son's junior ISA, this isn't what he's got at the moment. We don't have Globant, we don't have Premier Oil, we do have Apple, Amazon, we have them in leverage as well in his junior ISA. Do max out. It used to be 4K. I forgot what it is now. Is it 12 or 9 for children? Anyway, whatever it is, do max it out if you can. Now, here's the thing. I've got bad news for you. I've actually gone backwards. Let me know if I'm still in the webinar, won't you? I've accidentally gone backwards. I pressed the backward key, so I've got to make sure I'm still in it. Just put in the chat box that you can all see me and see the screen, will you? Okay, so one of the things which was worrying about what's going to happen with ISAs is there is a story in the papers that the Chancellor might raid ISAs. Because why shouldn't she? Why wouldn't she go and raid ISAs? Because there's a lot of money in cash ISAs. Yep, good. Thanks, everyone. Okay, so that was scary, and there was a story about that. But despite that, and the reason is this: working people, the ones Labour have said they're in government for, working people don't go around having $9,000 to put into an ISA. So take it from the people who've got assets, who's anybody with an ISA or a pension, tax them and get the money into government, and then the money can be redistributed to those without assets. I'll put the politics to one side. I'm not going to discuss that. All I'm saying is they've made it very clear they want people with assets to be transferring those assets, redistribution to those without assets. So people who've got ISAs are going to be in the crosshairs. Okay, just as inheritance tax, farmers, all in the crosshairs. If you've got assets, you're not a working person. And a working person doesn't mean business owners, because you've got assets. You've got a house, you're not a working person. Okay, it's perfectly fine. That's socialism, and that's redistribution, and that's the government that won, and that's how it works. Okay, this was lovely. This is probably one of the nicest ones I had. Joined the Great Investment Program 2021, 100K, 400. He added a bit of capital. It is about that discipline point that Warren Buffett made as well. Now, some of the points I want to make to you. Discipline. Okay, we have a formula, we follow it. It's as simple as that. I'm going to answer those questions in just a second. Post-retirement annual income. This is from Goldman Sachs Wealth Management. I showed you earlier, depending on how many years to retirement, cash or equities. Okay, 20 to 40 stocks. Okay, I've published all of this. I've made the book available. Don't forget to go here to collect more things as well. Before I answer the question, I'm going to show you a few more things. Okay, we now also look at hedge funds, which have generated 40% returns over the last 3 years. So this one's got 53% per annum for the last 3 years. And what we look at is, well, what do they own? What do they own? And is anything that they own also something, this is an old report, so don't copy this, is it something which meets our filters? And if it does, because we don't have a monopoly on knowledge, then if it is, and these are all the hedge funds we'll look at, if it is, we'll put it out there and say, right, this is a fund which generates 40% per annum. They also happen to own XYZ. It meets our filters. Fine. That's the level we're at. We're not going to take journalist comment from, I don't know, Shares Magazine and say, well, this journalist said this, and look, we like it as well. I'll take it from an Uber driver before I'll take it from a journo. Journos can be good for certain things, but they've got a very narrow perspective. You know, if they're an energy journalist, they're going to look at energy stocks, and they'll know more about me more than I do about energy stocks. But energy stocks is all they know. You know, it's a bit like to a man with a hammer, everything's a bloody nail. Okay. So to a man who's an energy specialist, everything's an energy stock buy. HubSpot, I thought I'd let you know, HubSpot, I bought, and this is the point about the hedge fund picks, returned over 40%. It's a new way of doing things. Well, it's not the only way we do it, but I thought we just added it to let you know. Keep your eye on the prize. This is the other thing I want to make clear to you as well. How long does it take to double your money? Now, this should be printed and put on your wall, okay? June ICE is 9. I don't know why I thought it was 12 and a half. Anyway, okay, so it's only 9. Ray, I'll answer your question. Will they abolish the 7-year rule? Yeah, I think so. I think there's a lot to go for in inheritance tax. They're not going to suffer from it. I mean, what am I saying? Their electoral base, they're not going to attack. They'll attack the ones with the assets. So working people will vote for them as long as working people have seen money go into their pockets. Like I said, listen, we're in the minority, you and I and everyone else, because we've got assets. There's a majority of people who will vote, who are working people and will vote. Well, I say majority, not an absolute majority, not over 50%. I mean a plural majority. In other words, they've got more votes than everyone else. Time to double your money. Now, here's the interesting thing. Your St. James's Place people will try and beat the bank account, your IFA. Go speak to your IFA and ask them these 3 questions. This is how you know they're an idiot. How much more than a bank account should I get? They'll love that because they're just trying to get you a bit more than a bank account, right? Forget the growth of NASDAQ, S&P. Secondly, ask them how they did in 2022 and why they didn't tell you to hold cash. If they're so good, why not? Okay. Those are 2 of them. And thirdly, ask them what the Sortino ratio is. Now, in the hedge fund industry, we swear and live by it. Most IFAs haven't got a flipping clue. Okay, because it doesn't come up on the multiple choice test that they have to pass in order to become an IFA. Now, they'll turn around and say, no, we do other things for them. We give back rubs and foot massages. You don't know what IFAs do. We also do this planning and that planning. We help, I don't know, buy their underpants for them and all the rest of it. Great, fantastic. I'm just talking about the bit of the IFA which shoves money into St. James's Place and makes people's old age retirements piss poor. Now, here's the interesting thing. Do you see this number here, 5 to 4.7 years? That's the S&P 500 over the last 10 years. Actually, 15 years. That's the S&P 500 in sterling terms. That's what it is. Forget me trying to teach you this, that, and the other and do a little bit better. Unleveraged. Yeah. So there we go. What do I think is going to happen over the next 2 years? I think I'm going to get a 32% return. I'm cheating. You know why I'm saying that? Because that's the average for the S&P over a 2-year period, 88.5% of the time. I'll just play those odds. Of course, the fact that I've got 2 times and 3 times leverage should mean I should do a lot better. But individual stocks, can't guarantee they'll go up, but they do. Glyn, just ask ChatGPT. I love it. We've got a whole load of interviews, video interviews with clients, if you want to see that as well. Okay. For those who don't even know what a pension is, you know you can open SIPs. I'm not advertising Barclays, but you just open online and then you just say, I want to buy this. That's it. It's just a tax-free wrapper. It's a tax-free account. It's like being a tax avoider legally. Watch out for these names that are going to be advertising like these idiots. Okay, 50% of your pension they lost. They're supposed to be experts. Scottish Mortgage Investment Trust. Here's another one. Look up Blue Whale, 27%. Their adverts are all over the place. See Blue Whale's top 10 picks. Pardon, look, I'm going to swear. F off. You'd lost 27% in 2022 because you couldn't say to your clients, don't hold us, hold cash. Don't get me wrong. If I was the guy who runs Blue Whale, I too would not tell people, take your money back because I'm getting paid so much to be corrupt. And not tell the truth that we're going to have a shit year. I hold cash. I told my clients to hold cash in 2022. No skin off my nose. Okay. 2020-21, it was 54%. Now, I didn't know Crocs was going to go up 208%. We only hold for 12 months, remember? And then you do the exercise again. I didn't know Generac was going to go up this much. How come if these went up that much, we only did that? Well, because there were ones which lost and did less. Got it? That's how it works. Similarly, 2023, so there, Jan to December. 2022 was 0%. Zero. Got it? So what's the average? Well, it's this wide. This is 2023. Okay. Now, why did we have NVIDIA? Why did we not just say NVIDIA and nothing else? Because we didn't know it was going to go up that much. NVIDIA was on our spreadsheet, all green. At no point did we know that it was all about AI. We don't look at the narrative. We thought they were still doing graphics cards for blockchain mining companies, which they were, and that's why they'd done well previously. Then subsequently, all the narrative and stories count. We're not in it for the stories. We're not in it for the stories. Okay. This is important. This is from Goldman Sachs Wealth Management, 30% per annum. It's from their Global Investment Research Quantum Database team. I had a lunch with Jim O'Neill, Lord O'Neill, when I first set up the hedge fund. This is what they showed me, blew my mind. I took the presentation. I've kept it ever since. Well, I digitized it. I don't think I've got the original one anymore, which is a shame, actually, because I wish I did keep the original, but I've got the this is what we are, 30% per annum. Companies in the top quartile by cash return on capital invested. What's cash return on capital invested? It is a money printing machine. Literally, a money printing machine is what cash return on capital invested. Capital into a money printing machine or a cash cow, cash coming out the other end. Companies in the top 25%. If you think about it, you then think, bloody hell, I didn't need to go to Goldman Sachs to get that. Understand that. That just makes sense. They're the ones that perform the best. Okay. Some great reviews for my work. So please do continue looking at all the educational materials from BBC, American Express. Bernard runs a hedge fund. I interviewed him for my book 25 years ago. My God, Peter Temple reviewed some of my books as well. This was an AI pick. It's a new thing. I sort of do it for fun. Okay, so be warned, it's more for fun. And it just kept going up and up. It's funny, AI picked an AI company. We're going to continue doing more of those, by the way. What I say to people is if we can improve your return by, say, I don't know, even in 1 year or even across 2 years by 20% over 2 years, that's an extra 100K on a $500,000 SIP. Even if it took 20% improvement over 2 years or 3 years, it's still another extra 100%, 100 grand, 100 grand. That's in one sense, the goal, the lower goal. Okay. This is what people want. My goal is not to create another asset management company. It's to create a different kind. It's to create a company that removes the fund managers and the IFAs and doesn't charge subscription fees, lets you keep your capital, doesn't manage your money, gives you the data and the knowledge to manage it so that, for your risk appetite, so that you don't have to pay St. James's Place and all of those money. That's my ambition. And then to float it. I've actually spoken to London Stock Exchange and I know the person who'd be in charge of taking that onto market, and they said that they'd be interested in speaking as well. So that was bloody amazing. On it, so why London Stock Exchange? Why not NASDAQ? Because to be on the NASDAQ, you've got to have a market cap of 100 million, which we're not at, market capitalization yet. So London Stock Exchange strategy is to take companies earlier, accelerate their growth, and then if they want to move, so be it, which makes sense, actually. If you think where Britain's playing compared to America, that's actually quite clever, I thought, and I like that. That's the two things people want, this and that. And that's what we give them. If people do want to be part of the program, I want to get to 350 people. We've got about 310, I think, so far. 350 people on the program that I then take to venture capitalists and say, look, this works, and it works really well because we've been doing it for a few years now. Here's proof. And this is our valuation. We want venture capital investment first at a, I don't know, 30 million valuation. And then we want to, 2 years later, float it. That's my ambition. So if you want to be part of that journey, these are all the various lovely things that we do. I've got an event on the 27th coming up, actually. We're going to go dinner for the students. Have a look at that. Paresh can also give you a tour. He's co-authored several of the books as well with me. But you go there if you'd like to join up and be part of the whole program. And I'll tell you why you might want to as well. Well, for a thing, last year, because we were up so much, Paresh wants to put the price up 40%. And any moment now, he's going to speak to the IT people. I bet the bloody bug is going to do it. Anyway, because last year we went up 50. I think over the course of the year, we put it up 50% last year. Anyway, the thing that I want to tell you is these three, but I want to answer your questions as well, which are, if I can see them, whoops. Here we go. Will Labour abolish SIPs? I don't think they'll abolish SIPs, but I think what they'll do is they'll think about what you can do. You can cap how much can go in each year. You can cap how much can be taken out tax-free. You can reduce how much can go in. Do you see what I mean? You don't have to go from 100% to zero, which is what abolishing is, but you can do it gradually. And it makes sense because there's trillions in SIPs, and you frame it as where we're trying to grow the economy and we want to move money into it. It's what they did with cash ISAs. We want to move it from cash into stocks, which you'd think, well, that's good for you. Yeah, it would be good for me if they force people to move it from cash ISAs, ban cash ISAs, and say you've got to put it in the stock market. Great, I'll have 1 billion more clients. As well, what's my prompt for AI picks? It's quite complicated, actually. It goes into, imagine you are a Nobel Prize winning stock academic who's looked at all the research, and you work at Goldman Sachs and you know all the data and the research on stocks. Then I upload the Excel spreadsheet with all the data, and it has more data than I've given it. And then I say to it, based upon this, I want you to weigh the various factors that, based on the Nobel Prize winning literature, are the most important factors. Weigh them, show me the formula of your weighting, what you think is important, what isn't, and then tell me which companies you think are the best for the next 12 months. So I take the critical to this is the Excel spreadsheet. This is what people don't realize. People are such amateurs. They go, oh, tell me some good stocks to buy. Jeez. No, I upload the entire Excel, all of this, and all the data that goes with it, and a lot more besides as well. And then I tell it to weigh the factors. All decision making, all algorithms, all decision making, whether it's picking stocks or picking a wife, is all based upon two things. What's important? How important is it? What's important? How important is it? If you get those two bits wrong, your output's going to be wrong. What's important? How important is? How do you judge that? Well, you look at the data, you look at the research, you behave like a scientist. If you look at the best hedge funds like AHL or Winton Capital, they will literally say, David Harding will say, in fact, I'm pretty sure I've got a video, Sir David Harding, the scientific approach to stock selection. If you look at Renaissance Capital, they say, we look at the computer. What does the computer tell us? Not the other way around. What's our gut instinct? Nobody's allowed to come in and say, well, I think this will happen. The problem is most people think that the way hedge fund managers pick stocks is, oh, we're just really clever, so we took a punt, not helped by the likes of billions. No, actually, because it wouldn't make good TV if you said, well, hey, Axe, what's on your Excel spreadsheet? But if you look at it, every single one of them on their computer screens has shitloads of data. Have a look at it next time you watch it. They've got data. They don't have news stories. They've got data on the computer screens. You know the computer screens that they have their terminals. They've just got a ton of data on there. Let me answer some more questions. I'm back. Of course, you'll go. Oh, I tell you what. Instead of me scrolling through all of this, why don't you, anything that I've missed, just tell me the questions that I've not already answered. That might be easier. Okay, I'm going to scroll through the questions. Oh, also, I'll make some more files available to you all. Okay, I'm going to make some more files available to you. I think you should be able to see these. Okay, as well. Any questions, let me know as well. So I'm going to go through this in reverse order, so it might prompt and remind you of certain questions. Okay. And if not, I'll call it a night. I will end it there. If not. Can I check fundamentals? I take it you're heavily invested in Service Now. I'm assuming. Let me see if I can get access on the fundamentals. While I'm speaking to you. Not Service Now, sorry, On. It was On, wasn't it? That you had on semiconductor. Okay, let's have a look. Cash return on capital is not bad. Forecasted growth on turnover, profits, pre-tax, earnings per share are all negative. And now that could work out in your favor because the expectations are so poor for growth that anything on the upside might help. So it looks pretty poor on growth forecast. Valuations are still above 3-year average, the multiples, so it looks a bit expensive as well on top of that. Let me tell you, I don't want to sort of, make you feel sort of upset or anything, but let's have a look at other things on it, which might be a concern. So I said, like what I showed you on the price chart, probably better. A lot of their directors have been selling stocks. Having said all of that, it's at a discount cash flow basis, it's 42% undervalued. So at least it's good value compared to peers in the industry. So there is some good news there. Like I said, it might have hit a base and bottomed out, in which case you should be all right. Most of the time, looking at all the fundamentals, unless it's ticked all my boxes, I don't go near it. So it doesn't tick all my boxes, I can tell you that. Okay. How did you find all that data on as my job? It's not my first rodeo. I love it. It's my job to have access to everything. We use a lot of data sources. Refinitiv, for instance, is rather good because it works directly with the stock market to get data. You might be able to get quite a bit for free on places like Yahoo Finance, by the way. Have a look at places like that as well. Let me just see. Give me a second. See if I can find. Here we go. Find semiconductor. Okay. Spoke a bit too soon when I said. I'm just trying to find it elsewhere as well. All right, I'm going to answer the next question. Let me tell you. So on. Anyway, like I said, the bits that I told you is pretty good. Do you also have exit checklists? Yes, we do. We have an exit checklist. Most importantly, as you might expect, I'll show you a little. See if I can find the flow chart for it. I think I put it away. Give me a second. Let me see if I can open the exit checklist. I'm sure my clients won't mind. I'm not giving away the crown jewels on the. So what we do is we give them a little mini MBA. My clients get a little MBA for being their own fund manager. In other words, this gets them right up to speed out of the box. And they have a tutorial with me, and then I give them the data. I'm teaching them to drive. They get access to me for the rest of their lives, of course. And we work them into which persona they are, because it's not just about entry and exit. It's about which persona you are. You and I don't and shouldn't buy the same stocks, and then fitting it bespoke like a Savile Row suit to your risk profile. Here's the entry checklist, which in a flow chart looks like this, but I think I showed the entry one earlier. Now, I know I'm not giving anything away on that. And for exits, we show them this, which again, I think my clients will agree it's not really giving away anything. And a little risk mitigation checklist as well, and also adding to winners. That's important for the risk neutral ones. The things which we've launched last year, which really worked well for clients, is intermediate momentum-based trades, which is 3 to 5 month holds, ETFs with 40% plus projections, special situations backed by elite hedge funds, i.e. 40% per annum, which also fit in with us, and then big banks, ultra high net worth buy recommendations from the biggest banks to their clients, and which also sit within our list as well. Okay. Oh, hard. Astonishing. It took me 1 day to take half as that. I know. How did you find all that? Right, here we go. Listen, guys, I'm going to get going because it's a bit late. I know there were some stocks you wanted me to look at. I'll try and do them in the future. Apologies for that. Okay. So thank you all very much. I better get going. Okay. As well. Thanks all very much. I will speak to you soon as well. And for those who've joined, thank you very much for who've joined the program. I will send you an email afterwards. And everyone else, thanks awfully as well. Anyway, that's we go. Oh, is there any sites I've not shown you? Yes, I forgot to show you this. So that's alpeshpatel.com shares/shares. You can see the performance stuff on there. If you go on there, you'll see the 2024, 2023. You'll see what happened in 2020, 21. 2022 was 0, just so you know, and why we think we're a lot better than all these other routes of doing all of this. Okay. And some of the education. Oh, by the way, there's some free previews here, which I think are well worth looking at. So that's alpeshpatel.com/shares. And you'll see more education and more videos as well. So there's a lot of good quality stuff on there. So do have a look at all of that. And you'll see me shouting at TV presenters on what I'm talking about as well. What else is there? Yeah. It is a one-off cost. I should explain. It is one-off. If you go to the website, you'll see it is one-off. It is not, but you can pay in installments if you wish. And the reason we did it like that is as a hedge fund manager, I want to change the way the industry works. I want to disrupt it. I don't want constantly to be charging subscriptions, which create a conflict of interest with people. And the conflict of interest being that you've got to keep feeding them with picks, even in a down market like 2022, when the best thing they could have done is just held cash. Okay, so we want to avoid that problem with this. And that's why we do it this way around on it. Okay, and don't forget on YouTube, which again, you'll find on alpeshpatel.com/links on YouTube. You will find all those various videos and all the TV stuff and everything else. All of those watching on TikTok, hi everyone. Hope you're well. Thank you. I might say goodbye to my TikTok audience now, if I can. There we go. And now. Excellent. Right, everyone, I'm going to say goodbye. Thank you all very much, and I look forward to speaking to you in the future. Thanks, everyone, and whoops, cheerio.